Hi, my name is Brian Walters. My company, Brian Walters and Associates, performs business valuations in a variety of circumstances. As I said in my last video, I want to put together a brief example to demonstrate how a family limited partnership can be an effective tax planning tool for you. As an example, let's say that there is your client who owns several different assets that you want to place into a family limited partnership or an FLP. And let's say, for example, you have about $25 million worth of assets. Those may be real estate, they may be investment accounts, they may be cash, whatever those assets are. They total about $25 million and you want to put them into a family limited partnership. Now, because of the very restrictive nature of an FLP, generally you're allowed to recognize certain discounts on the value of those assets. Those two discounts are the discount for lack of control and the discount for lack of marketability. And those discounts are multiplicative. In other words, you apply one and then the other. So to continue the example, let's say that the discount for lack of control is 25%, and let's say that the discount for lack of marketability is 20%. When you apply those in multiplicative fashion, the total discount is 40%. And so in those circumstances, you're taking 40% off of the value of the $25 million gross amount of the assets that you have, which means that under those circumstances, you're dealing with a net value of about $15 million. So let's further assume that your marginal tax rate on the gift taxes is 28%. At the gross level, without an FLP, you'd be paying 28% of $25 million, which would be somewhere around $7 million. However, if it is shielded in the form of an FLP, you'd only be paying taxes 28% on $15 million, which translates to somewhere around $4.2 million. In that situation, you're saving $2.8 million in taxes. I want to stress that that's just a very loose example, just to allow you to understand how the numbers work. And in a real world situation, the numbers would be completely different, and the situation would be such that there might be an additional complication, or there may be a little bit more complexity to the valuation. But the main point should not be missed. The main point is that a family limited partnership will allow you to save on taxes in certain situations. So it's very important, given the last video that I put out about the ability for you to recognize those discounts and how that might be going away, that if you are someone for whom this potential type of tax strategy might work, that there's a very small window for you to be able to take advantage of. So if you believe that this can help you, or whether you know somebody else who it might be able to help, there is a very small window, potentially by the end of this year, 2016, where this would apply, because after that, if the proposals as they are currently proposed would be codified, then you would lose that ability altogether. So if you would like to ask a couple questions about that, or discuss how this potential game changer might benefit you or how it might not benefit you, please get in touch with me and I'd be happy to discuss your situation in confidence. Thank you very much.